Hi, everybody, and welcome to the week ahead. My name is Tony Nash. We're joined today by Tracy Schuchart and Brent Johnson. So thanks, guys, for joining us. I really appreciate the time to talk about what's going on in markets this week and next week. Before we get started, I want to remind you of our $50 promo for CI Futures. CI Futures is a subscription platform to get forecasts for thousands of items, currencies, commodities, equity indices, and economics. The currencies, commodities, equities are refreshed every week. So every Monday you come in for a new forecast. Economics forecast every month. That $50 a month promo ends on September 21st. So please take a look now, go in and check it out. And if you have any questions, let us know. We're happy to answer them. So thanks for taking the time to do that. So Brent and Tracy, it has been a terrible week, right, in markets. Like, it is not looking good for really anybody, at least on the long side. And so a lot of that seemed to change when the CPI number came out. It's like people woke up and were like, oh no, the terminal rate's going to be higher, and just everything flushes out, right? And earnings and, a bunch of other stuff. So we can go into a lot of specifics, but one of the items that I've been really curious about for weeks, if not years, ever since I met Brent in 2018, 19, is the dollar. So we're going to go a little bit deep into the dollar today. We're also going to look at crude. Crude's obviously been falling, so we're going to ask Tracy kind of how long is that going to last, and then we're going to do a little bit of Fed talk, because the Fed meets in the week ahead, and I want to really understand kind of when does the Fed stop. So those are our key themes today. So Brent, welcome. Thanks again for joining us. I'd really like to talk through the dollar, and we are where we are, which is amazing, and you had seen this years ago. On the screen, I've got a chart of our CI futures forecast, which shows the dollar continuing to rise over the next year. We've got some bumps in there. But for the most part, we see a persistently strong dollar. So I'm curious, like, what got us here and what will continue to push the dollar higher?
Sure. Well, first of all, thanks for having me. I always enjoy talking to you, Tony. The reason I like talking to you is you'll talk a lot about Asia, but you've actually lived there and you actually know what you're talking about, rather than people who've just read it in a book.
Yep.
And same with Tracy. So I'm happy to do this and happy to do it anytime you invite me. But anyway, that's what's really going on with the dollar is a function of the fact that it's not only the Fed and it's not only the US that has, for lack of a better word, idiotic leaders. The rest of the world does too. And I think over the last several years, at least in the retail investment world, there's been this theme that the Fed is out of control, the government's out of control, they're going to spend all this money, the dollar's going to pay the price, and it's going to get inflated away and go to zero. And, the rest of the world's going to do great and we're going to do poor. And I understand that view if you just analyze the United States. But the problem is you can't just analyze the United States because it's a big world and everything's interconnected. And all of the problems that people have forecast to fall upon the US dollar are currently happening to a greater extent in Europe and Asia. And the budget deficits, the printing of the money, the central bank support, the holding down of rates, all of that applies even more so to Japan and Europe than it does to the United States. And that's really what you're seeing. Over the last, let's just call it a year, you've seen the yen fall 20% versus the dollar. That is an incredible move for any currency, but it is an absolutely astonishing move for a major currency, specifically the third biggest currency in the world, or some would even argue the second biggest currency in the world. And then you've seen the euro over the last year is down 10 or 15%. So, I mean, these are very big moves. And the reason is because the Fed is raising rates. So on a relative basis, we have higher rates than those two big competitors. And on a relative basis, those two big competitors are doing more monetary stimulus or QE or extraordinary measures, however you want to define that central bank activity. And you always, because the globe runs on the dollar, there is a persistent and consistent bid for the dollar globally. And so it's really a supply versus a demand issue. Now, everybody always focuses on the supply. Central banks are increasing the currency in circulation. They're going to print all this money. And so therefore the dollar falls or the currency falls. Well, that's just focusing on the supply side. But again, you have to remember that all central banks are increasing supply. But the demand is what makes the difference, in that there is global demand for the dollar. Now, whether you think there should be, whether you think it's the right thing, it doesn't really matter. It just is. That's the way the system works.
Yeah.
But there is not that same global demand for yen. There's not that same global demand for yuan. There's not the same global demand for euros or reals or florins or liras or anything. And so what you're really seeing play out is Triffin's dilemma. And so I've spoke about this before, but Triffin's dilemma is a economic theory that states that if you have a single country's currency that also serves as the global reserve currency, at some point, the needs of the domestic economy for that global reserve currency will come into conflict with the needs of the global economy. And that's what we have. We have an inflationary pressure problem in the United States. The Fed is very embarrassed about it. They got it wrong, and now they need to do something about it, and they're bound and determined to try to bring it under control. And so they're raising rates to counteract that. Well, when you raise rates, you're tightening the monetary supply, and that's happening. That's fine for the US, but there's many countries around the world that cannot handle that right now. But that's what's happening. And so the needs of the domestic economy are in conflict with the needs of the global economy, and it's going to be the global economy that suffers more than the domestic economy as a result. It doesn't mean that the domestic economy won't be hurt. It just means on a relative basis, you want to be closer to the money than far away from the money. And because we have the global reserve currency, we're closer to the money.
Right. So, okay. So it's interesting when you talk about the dollar versus other currencies, and we often hear people say, oh, CNY is rising as a share of spend, which that's debatable. But from my perspective, it's not the dollar that's kind of in the gladiator ring of currencies. It's the yen, it's the euro, it's the British pound, it's the Aussie dollar. It's these secondary currencies. They're going to lose share before the dollar does. Is that wrong? Like,
no, I think that's absolutely right. And again, I think gladiator, that's a very good way to put it. Now, no gladiator walks into the ring and think they're not going to at least get a few scratches, right?
Right.
It's going to hurt. That's just the nature of being a gladiator. But what matters is who's standing at the end of the day, right? And so I think it's these other currencies are getting hurt by the battle more so than the dollar. It doesn't mean that we're not getting hurt. It doesn't mean it doesn't sting. It doesn't mean there isn't going to be any pain involved. But at the end of the day, if you're at war, you want to be the last man standing. And because of the way the system is designed, I believe that will be the US dollar. And the other thing that I would just quickly point out is a lot of people say, why can't you see it? It's very obvious. The rest of the world wants to de-dollarize. They're putting all of these trade deals in place. The dollar's falling as a percent of reserves, et cetera, et cetera, et cetera. And the point I would make is, yes, I do see it. I agree with you. The world would like to de-dollarize, but it's much harder to de-dollarize than just saying, just because you put an announcement out there doesn't mean you're actually going to be able to do it. Yeah. I like to make the analogy that I've said I want to lose weight and get in great shape for 20 years. It doesn't mean it's going to happen. It hasn't happened yet. But that's the headline versus reality, right? Yeah. And so I just think that's where we're at. And the dollar, for better or worse, it's a rigged game in favor of the dollar. And the US set it up that way as the global hegemon. They set it up that way. Yep. Now, it doesn't mean they're not trying. It doesn't mean that the world doesn't want to get away from it. It's just very hard to do it. Yeah. And the last thing I'll say, and I'll shut up, but the other thing I would say is the process of de-dollarization, even if it is successful, will not be a calm transition. Yep. And the process of de-dollarization is not necessarily, and in my opinion, not probable to be negative for the price of the dollar. I think the volatility and the lack of liquidity in dollars that would go along with de-dollarization would actually squeeze the price of the dollar higher. And so it doesn't matter to me whether de-dollarization happens or not. Right. I think the dollar is going higher for all of these reasons.
Right. And I think what's funny there is people always put de-dollarization in this almost moralistic language. It's a good or a bad thing.
Yes, right.
And it's just not. It just is, right?
It just is. That's right.
Sorry, Tracy, you were saying?
Yeah, I know. I just had a question for Brent. Do you see at any point that there's some kind of intervention on the dollar gets too strong? Because it's really, it's going to crush emerging markets. And so, do you think there's any point in which, Yellen kind of backs off, tries to rein it in a little bit?
I do think they will. And that's why I don't think the dollar is going to go. I think the dollar is going to go back to all-time highs before this is all said and done. I don't think it's going to be a straight line. It can't be a straight line without absolute devastation. Doesn't mean it can't happen, but I think this is going to play out over, several years rather than several weeks. It could play out over several weeks, but I think it will take longer. And the reason I think it will take longer is I think that they will interact or they will get involved, as you're suggesting, Tracy. I actually think right now the Fed and the Treasury want the dollar strong. I think they're using it as a weapon or as a tool. It's something that can be used very effectively. Again, whether you think it should be used or not, I don't care. I just think it will be, and I think it is being. And so I think that will continue. And I think, but I think the Fed and the Treasury, they want the dollar higher, but they want it done in a measured fashion that they can control. Right? If it starts to get out of control, I think that they will rein it in. I think they want some of the other parts of the world to be in economic pain, but I don't think they want the whole system to collapse. And so my guess is that, we'll get the dollar higher. Maybe it goes to 115, 120, and then they'll do something. It'll pull back for 6 months, 3 months, whatever. And then it'll get higher again and they'll come out, they'll do something else. Yep. So I think this will be a process, a little bit of a roller coaster up and down, but I think that the general trend is higher, and I think there's more pain to come for the global economy as a result.
Yep. Brent, real quick before we get on to oil, you sent out a tweet earlier this week that said you think that we're going to come to a point where both the dollar and equities and US equities are rising. Can you walk us through that? Just real quickly. I know there's a very detailed thesis behind that, but can you walk us through that very quickly so we understand kind of what you're talking about there?
Yeah. So the first thing I'll say for anybody who's just kind of passing through this conversation is that I don't think this is happening right now. It could happen right now. In the short term, I expect US equities to go lower. I think that's just kind of where markets are headed. But as the pain develops throughout the global economy, I think we are going to experience a global sovereign debt crisis. And when the world, the US included, starts selling sovereign debt rather than buying sovereign debt, I think that money will have to. Now, some of the money will just be it'll just go poof, it'll be gone. And so that money won't have anywhere to go. But the people who start selling the bonds, looking for another place to go, I think the next best place to go will eventually be US equities. And I think US equities will be seen as the new, I don't want to say new treasuries, that's a little bit hard to say, but on a relative basis, the place where big global capital can go that is the most advantageous to them. And so I think we will get into a point in the sovereign debt crisis where US equities will get safe haven flows. And I think the whole world will potentially be printing more money, right? So be sending more liquidity out there. And so I think that liquidity that is generated, what little liquidity there is, I think will find its way into the US and the US Dow, big blue chip stocks. And I think they'll go higher. And I might be wrong on that, but that's my working thesis as of right now.
Great. Okay, that's good. Okay, great. Thanks for that, Tracy. Let's move on to crude oil. Obviously, we've seen crude, take some hits over the past few weeks, and we've got a WTI chart on the screen right now. So, how low will crude go? Are we almost there? Are we headed to 65 where it was for a while? And what then pushes it higher?
I don't really want to forecast exactly where crude is going to go. I definitely think that we could see some more downside. But we have to look at what is weighing on price and sentiment right now. Is one, there's more Russian barrels on the market than everybody anticipated.
Yep.
Two, you've got never-ending zero COVID China lockdowns that haven't seemed to let up yet. We also have EU fears of EU recession. Right. And then we've had, 160 million barrels of SPR thrown on the market, right? And so that's really weighing on kind of on the front end of the curve. And so those are the things kind of weighing on the on sentiment right now. So that's why we're seeing a lot of weakness. That said, if we look at the fundamentals of the market is still very tight. We're still drawing globally. We definitely have a distillate diesel problem that is global. And I think where we start to see kind of a change in this, I think, when it comes to the end of October, when the SPR is done, finished with, because if you kind of been looking over the last couple of weeks, had we not had such large SPR draws, we would have actually been drawing, right, a regular stock. So it's not as if that, that oil is going, is piling up anywhere. So I think as soon as the SPR stops, I think after midterms, because I think this administration is trying to do whatever they can to suppress the price of oil, thus gasoline. And I also think that we have to see, what happens in China after the People's Party Congress in the middle of October, and kind of see what their policy is going to be, moving forward. Are they going to open up? I mean, they're looking at, they want, 5.5% YOY GDP by the end of the year, which they're
they'll hit it.
They'll hit it.
We're on the nose. We can guarantee that.
Yeah.
But, I think they're going to, have to start stimulating the economy a little bit more. And we kind of saw an announcement, Evergrande is going to start financing more construction projects and whatnot, going into starting at the end of September. So I think we'll probably see the last quarter if, we get a little stimulus, and if they back on their policy, because that's the big thing for oil right now, is that if that demand comes back, because they're down about 2.7% on the year, and as far as consumption is concerned. So I think, if that demand comes rushing back, that's going to be a huge upside surprise for the market. I think, I think over the long run, oil is going higher, but, looking out into 2023, I just think that's the trajectory of it. I'm not calling for $200 oil, anything crazy like that. I just
or
think
25.
I just think that, we will see higher oil, and I think we're, poised to see higher for longer.
Okay,
right?
last
the functionality of the market, and the fact that we have no capex for the last 7 years. So
right. So last month you said to look 3 to 4 months out, look at the curves 3 to 4 months out to understand kind of what the real oil price was or is going to be, right? And so that would be 2 to 3 months now. So that's November, December.
You want to just look at those spreads are widening out or not, right? So you want to see if we're good, if we're moving into more backwardation, and even more backwardated markets.
Yeah.
Right. So you kind of want to look at that.
Okay, so I paid $2.88 a gallon for gas at my local last night.
Well,
so what's that? I'm in Texas.
Show off.
We're the energy capital of the world. Yeah, I'm going to show it off. So anyway, so that is kind of coming down, right? And energy has been the biggest upward factor in some of the inflation issues. So that's good news, at least until the election. Hey, I'll take it while I can get it, right? And if it heads back up after the election, I think we're all prepared for that on some level, right? So, I guess, so SPR ends, as you said, election happens, there's no political reason necessarily to suppress these prices and so on and so forth. So, do you expect to see almost a slingshot, in say December, where things trend higher pretty quickly?
I don't think we'll have, I don't want to call it a slingshot, because, but anything can happen in the oil market. I mean, we've seen $7 to $10 in a day before, so that's not unheard of. But I do think we go higher, especially if you're looking into, the market's going to get even tighter in December because of tax reasons. December 31st is the tax assessment date for the barrels that you have on hand. So they tend to pull back on production so they can move out inventory as much as they can, so they're not taxed on it at the end of the year. So usually we see a little decline in production anyway in December. And the second half of December, we do see prices start to rebound off the seasonal, the regular seasonal trend low.
Okay. Okay. So that'd be normal. Brent, I think you had a question for Tracy on crude markets as well.
Well, yeah, I actually had two quick questions. One, I wanted to get your thoughts on the fact that India and China are buying oil at a discount from Russia, and then there's lots of stories about them selling that oil on to Europe or other places, and so they're making that spread. I just wanted to get your thoughts on that and logistically how that actually takes place.
Yeah, so if you're looking at India, definitely they are buying discounted crude. What they do is they don't resell that to Europe. What they do is they blend it and they sell fuel, right? So that's refined. So it's really hard to trace what's in, they don't trace those barrels that way. And so that's how that oil is kind of emerging back in Europe. It's really by way of refined products. Now, when we talk about China with the gas, really what they're doing is they're buying, gas right now at literally half off from Russia, and they're turning around and selling their own gas to Europe for, the higher marked up European
the gas
price.
they already have. So they're selling the gas they already have.
Right, right. So that's kind of how that's
Cool.
working.
And then just the other question I had for you quickly is, were you surprised? I was surprised this week when the rumor was floated by the whoever floated it that they would restock the SPR at $80. It seems like they're doing everything they can to get the price lower, and then to have that rumor come out and put a kind of a floor under it was kind of surprising to me. So I didn't maybe nothing more than just a speculation, but did you have any thoughts on that?
Yeah, I mean, basically they put a floor on it. Everybody's calling it, the Biden put now.
Right.
But the thing is that it's all nice and well to say you want to do that, but they still got another 60 million barrels that they need to release. And then by the time by the time those contracts go through and people, and you want to refill the SPR, I mean, that's months away. So, we're looking at months and months down the road, and who knows what oil price could be then.
Right,
so,
right.
to me, it was just, another try to jawbone the market down lower.
It kind of reminded me of the ECB, where they're raising rates on one hand, but they're buying bonds with the other. It's Biden wants his cap. He's got a collar on it. He's trying to put a cap on it and a put on it.
Yeah, strategy.
Yeah.
Okay, good. Okay, so let's move on to a little bit more of kind of the Fed Fed talk. There's a Fed meeting next week, and when CPI came out this week, the terminal rate really rose very quickly, and that's when we started to see equities fall pretty dramatically. And we've got on the screen right now expectations for the rates coming out of each meeting. So 75 in September, 75 in November, and another 50 in December. And so that has accelerated the expectations for the Fed by about 25, 50 basis points. So kind of when does the Fed stop? Basically from where you are now, do you think this continues to accelerate into 2023? Or, given, let's say, CPI, of course, on a year-on-year basis, it looks terrible. But once we get to November, when CPI really started to accelerate November 21, do we start to see some of those base effects in a year-on-year basis? And the Fed starts to pull back a little bit and go, okay, wait a minute, maybe we're okay with the plan we have when we stop at, say, 450 or whatever as a terminal rate. The other complicating factor I'll add in there is University of Michigan survey came out on Friday, and it's a bit lower than what was expected. And the Fed has really been looking to University of Michigan, which is kind of a semi-serious survey, but they've really used that to justify some of their decisions. So, we obviously have a mixed environment, but I'm wondering, with all of this stuff coming out this week, do we expect the Fed to keep marching pretty aggressively into 2023?
So I'll take that first. So I actually do expect them to keep marching higher into 2023. And I say that for a couple of reasons. And I'm going to qualify this and say that they will pivot when they have to pivot, but I don't think they're going to pivot until they have to pivot. And so I think a lot of people that are predicting the pivot are misunderstanding the Fed's intentions, and perhaps for good reason. They've done a fantastic job of ruining their credibility, so it's understandable not to believe them. But in this case, I think you kind of have to believe them, and I'll tell you why I think you have to believe them. Number one, I think they don't mind the dollar being stronger. I think that's kind of policy that I spoke of earlier in conjunction with the Treasury. Number two, I think they want asset prices lower. So the fact that the stock market goes down, I don't think would bother them. I think if the Dow was at 28,000 and the S&P was at 3,600, I think they'd say that's totally fine. I don't think they have a problem with that, as long as it's not collapsing, right? Now, if it collapses, then they have to come in, and they will come in. But I don't think they mind if the stock market's 10 or 20% lower than here. The third thing I'd say is the Fed or central banks in general, they're always lagging. They're a reactionary agency. They're not a predictive agency. We all know that they can't predict anything anyway. So I'm not sure I want them predicting things, but they're always behind the curve, because they always wait until they see it and then they react, right? They come in and they try to save the day. So when things get really bad, then they'll eventually come in and, provide support. And when things when they're always too late to tighten, right? And like they are now. So, and then they try to make up for it. So I think they're going to, despite, like you said, the Michigan number starting to come down, Atlanta Fed's already slashed their GDP. So even though they're getting these signals that things are slowing down, they're not reacting to it yet. They will react to it late. And then the fourth thing I'd say is that I think Powell is mad and he's pouting, right? So he was really, well, not just Powell, but mainly Powell, but he got all this advice from all his staff and his other, however many PhD staffers they have at the Fed, and they all said, inflation's transitory and it's going to be fine. And then it wasn't, right? And so and now he's mad. And so he's like,
because he's a lawyer, not an economist.
Yeah, and I'm going to do something. I'm going to do something about it. And if you don't think that I can bring inflation down, well, then you just watch me, right? And I'll take my ball and go home. And his ball is interest rate, so he's taking them higher, and he's taking them home. He's taking them higher. And so it come hell or high water. And I don't, after the I don't know, the chink in their armor or the threat to their credibility that they've had over the last year or two, I think the last thing in the world that Powell wants to deal with is the fact that if he's slowed down, or God forbid cut rates, and then inflation kept going higher, that would look even worse than waiting for it to crumble, right? So I think for all of those reasons, you kind of have to take them at their word. Again,
so
I'm not saying that you go in
in early 2023. You're not expecting
not unless the markets force them to do it. And the markets might force them to do it. I'm not saying that that's out of the possibility. The only thing I don't like saying about this is the whole they're going to hike until it breaks theory, right? The only thing I agree with that. The thing I don't like about it is everybody else seems to agree with it now too. That seems to be the common refrain, is that they're going to hike until something breaks, and everybody says, yeah, that's kind of what's going to happen. Usually when everybody thinks something, it doesn't happen that way, but I don't, as long as equity prices are higher, and as long as inflationary prints keep coming in high, I think they continue hiking. And think about it, inflation could fall by 30% and it's still at 5 or 6, which is still 2 or 3 times higher than their goal. So is there a path to a pivot? Yeah, I think there's a path to a pivot, but every week when people come out every week and they're going to pivot. I don't think they're pivoting next week, and I don't think they're pivoting in October unless they have to.
Interesting. Tracy, what do you think on that?
Yeah, I mean, I absolutely agree. I mean, if all the data coming in, there's no way they're not doing 75 next week. Right. In my opinion, I could be wrong. Somebody will come back to me if I'm wrong, but yeah, I mean, I think that's pretty much a lock.
Yeah, I mean, I think short of, let's say, sometime in Q4, Russia-Ukraine ends and China says we're not going to lock down anymore. That would fundamentally change the Fed's calculus, right?
Well, if they weren't locked down anymore and it pushed demand higher and it pushed prices higher as a result of demand increasing, then to me that would keep them on their path to hiking. The flip side, and this is the flip side, is that if something breaks in China and China has to devalue or revalue the yuan in order to deal with the the real estate collapse or the internal problems, whatever it is, that could send a deflationary wave to the rest of the world. So I'm not going to sit here and deny the inflationary pressures that we're seeing. But I think to a certain extent, people have again dumped themselves into the inflation camp or the deflation camp. And I think we're going to have periods of both. I think if you fundamentally understand the design of the monetary system, the threat of a deflationary wave is always there. But if you don't admit that the inflationary pressures are here, I think you're also got your head in the sand. So
Yeah.
I've said this several times, but I will admit to a big mistake, and that is for several years I hated the term stagflation. I thought it was a cop-out. I thought it was for people who just couldn't decide if they were in the inflation or deflation camp. But I think that's what we have, and I think we have it in spades. I think some assets and some prices are going to continue to rise and be higher, and I think others are going to collapse. And that's what makes it so hard to deal with. So to anybody I ever took a shot at for them using stagflation as a cop-out, I apologize. I'm with you now. I got that part wrong.
Brent, one of the things I admire about you is you're not afraid to say you were wrong, right? Which is
I mean, that's, you know, do you mind if I just make a comment on this really quick?
Sure.
I think too often in our business, you know, people will make a call and then they're just so afraid to change it. Or you'll make a call and then somebody else will call you out on it if you got it wrong. I mean, at the end of the day, our job is sort of to predict the future, right? And so anybody who thinks that they can accurately predict the future 100% of the time has the biggest ego in the history of the world.
Exactly.
So that the reason I don't mind making predictions is, number one, I don't mind being wrong, because I don't think I'm the smartest guy in history. And if I get something wrong, then I'll have to deal with it. But this idea that we're always going to be right and we know everything, it's ridiculous. So anyway, we're all speculating at the end of the day.
That's right. So, okay, real quickly, guys, what are you looking for in the week ahead? More the same, disappointment, difficulties, headwind, all that stuff until the Fed meeting? Is it just kind of, is that what we're looking for until the press conference?
I think where the markets will be, you know, in limbo, definitely until the Fed. You know, we might see, you know, I mean, everybody expects 75. You know, we get 75, maybe we see a bounce in equities, actually, you know, kind of, because it's already done with.
Right.
There's no question anymore. So maybe we get a bounce after that.
Slightly less hawkish language than is expected.
Right.
Still hawkish.
Well, and I think that's right. I mean, at the end of now, we've got the potential, right, of maybe 100 basis points, right? So if they come in, you know, a couple of weeks ago, although now there's a path to pivot, they're probably only going to do 50 basis points in September. Well, then, you know, we got the CPI print and it's 75. 75 is going to happen. Then a couple of people go, oh, 100's now on the table, right? So now if they only come out and do 75, maybe the market kind of breathes a little bit. So, okay, at least it wasn't 100.
Yeah.
So my guess is that we would have some volatility leading up to the meeting. Maybe that they do 75, perhaps things get a little bit of a bounce as a breather. But you know, I don't think markets are going to change a whole lot between now and the election. I mean, I think they're going to be volatile. I think the Fed's going to keep hiking, and I think market, you know, Powell said it himself, right? We had the boom and now we have to deal with the pain. This is the unfortunate side effect of what we have to do. So he's telling you he's going to cause pain. Right? He just doesn't want to collapse. So if it starts to collapse, it's the sad truth, right?
It's the sad truth. Guys, thank you so much for your time. Thank you so much. Have a great weekend and have a great week ahead. Thank you so much.
Thanks for having me. I enjoyed it.
Thank you.